At midnight, nothing magical happens. No sirens, no alerts, but somewhere, silently, the amount of money in the world changes. Not because someone printed a stack of bills, not because you earned or spent anything. It changes because a decision was made earlier by people you've never met, using rules most people don't realize exist. And that raises an uncomfortable question. Who actually decides how much money exists each year? Because it's probably not who you think. Most of us grow up with a simple picture. Money is printed by the government. They print too much, prices go up. They print too little, the economy slows. Clean, logical, wrong. If money worked that way, it would be easy to track. But modern money doesn't come from printing presses. It comes from something far quieter and far more powerful. Before we get there, here's why this matters right now. Over the last few years, people watched prices jump faster than their salaries. Savings felt smaller, debt felt heavier, and everyone asked the same question in different ways. Where did all this money come from? And just as important, why does it feel like I didn't get any of it? To answer that, we need to strip money down to what it actually is today. Not cash, not coins, mostly numbers. Open your banking app. That balance isn't money sitting somewhere in a vault with your name on it. It's a promise, a record, a liability for a bank. In modern economies, most money is created the moment someone takes a loan. Not by the government, by banks. This is the part that usually shocks people. When a bank gives you a loan, it doesn't hand you someone else's money. It creates new money out of nothing but trust, regulation, and a keyboard. Let's say you take a home loan. The bank types numbers into your account. Your balance goes up. The seller gets paid. New money now exists in the system. No printing, no transfer from a giant pile of savings, just creation. That means most money in circulation today exists because someone, somewhere agreed to go into debt. So who controls how much money exists each year? At first glance, it seems like banks do, but banks don't act freely. They sit inside a system with invisible walls. Those walls are built by central banks, the Federal Reserve, the ECB, the RBI. Different names, same role. Central banks don't decide how much money exists directly. They decide the conditions under which money can be created. Think of them less like a faucet and more like the pressure in the pipes. The main lever they pull is interest rates. Raise rates, borrowing becomes expensive. Fewer loans, slower money creation. Lower rates, borrowing feels easy. More loans, more money created. But interest rates are only the surface. Behind the scenes, there's something even more influential. Reserves. Banks are required to hold a certain amount of safe money relative to their risky loans. That requirement can be loosened or tightened. Loosen it, banks can lend more. Tighten it, lending slows. And then there's the big one people heard about but rarely understand: quantitative easing. It sounds technical. It's actually simple. The central bank buys assets, usually government bonds, from banks and institutions, and it pays for them with newly created money. Those sellers now have fresh cash. Banks now have more reserves, which makes lending easier. More lending means more money creation. Again, no printing press, just balance sheets growing. During crises, this process accelerates. In 2008, after the financial system nearly collapsed, central banks stepped in aggressively. In 2020, they went further than ever before. Trillions were created in months, not handed directly to people, injected into financial systems. This is where the irony creeps in. Money is created to stimulate the economy, but it enters through markets, banks, and asset prices first. Stocks, bonds, real estate, which means the people closest to those systems feel rich first, sometimes only. By the time money reaches wages and everyday spending, prices have already adjusted, so it feels like money was created, just not for you. Now here's the part most explanations skip. Money doesn't just appear, it's supposed to disappear too. Every loan that creates money also destroys money when it's paid back. Principal repayments erase money from existence. That means the system requires constant new borrowing just to stay stable. If borrowing slows too much, money supply shrinks. That's deflation territory. Defaults, layoffs, recessions. So, central banks walk a tightrope. Too much money creation and prices run ahead of incomes. Too little and the system starts to seize. There is no neutral setting. Every choice benefits someone and hurts someone else. Low rates help borrowers. They punish savers. High rates reward cash. They crush debt-heavy households and businesses. And central banks know this, which leads to a quiet truth. Decisions about money supply are also decisions about wealth distribution, even when no one says it out loud. Now here's the part most explanations skip. We're often told central banks control inflation. They don't. They react to it, with delays, using blunt tools based on incomplete data. By the time inflation shows up clearly in the numbers, the money that caused it was created years earlier. So when rates suddenly rise, it feels like punishment for a crime you don't remember committing. Because, in a way, it is. The system runs on lag. And the people making decisions are always driving, looking in the rearview mirror. Zoom out further and the stakes get bigger. Governments run deficits. They borrow year after year. Central banks buy a portion of that debt directly or indirectly. This blurs the line between monetary policy and government finance, not in a dramatic conspiracy way, in a slow, normalized, technical way. Money creation becomes the lubricant that keeps everything moving. Until it doesn't. Because trust is the real foundation here. Money works because we believe others will accept it tomorrow. Banks work because we believe deposits are safe. Debt works because we believe future income will exist. If that belief cracks, numbers on screens don't mean much. So, who actually decides how much money exists each year? Not a single person, not a secret room. It's a system. Central banks set conditions. Banks respond by lending or pulling back. Borrowers decide whether to take on risk. Markets amplify everything. Money supply emerges from all of that. Messy, political, human. And here's the final uncomfortable part. You don't get a vote. You feel the consequences in prices, wages, rent, and savings. But the decisions are made far upstream, by people trying to prevent the last crisis while unknowingly setting up the next one. So, the real question isn't just who decides how much money exists each year. It's this: how long can a system built on endless trust, endless borrowing, and delayed consequences keep working before the math finally demands to be paid?